Okay, good morning, everyone. We will be going through the basics of Dow theory, and we will see how the Dow theory exactly, or to some extent at least, it matches up with the price action rules, that the different rules that we follow. So the Dow theory was actually it came into being around the 1900s, between 1900 and 1902. So Dow was actually Charles Dow. He was actually publishing some papers between 1900 and 1902, and based on the analysis of those papers, based on the different interpretations of those papers, the Dow theory actually came into existence, right? So it was based on a series of articles that he published in Wall Street Journal between 1900 and 1902, and till today, this Dow theory is meant to be the grandfather of all technical analysis. So as we will go through the Dow theory, you will actually understand that what are the different things that we use nowadays in the current scenario, and those things were actually formulated around 100 years back, right? The theory was actually intended to find how the economy was doing, how the business market as a whole in a particular country or in a particular region was doing. And based on that, he had certain findings, and based on those findings, he wrote those articles, and those articles slowly became widespread. It became very popular with different traders. And at that point of time, there were several different interpretations. There were disadvantages that were called out. We will talk about some of the disadvantages as well. And based on that, several changes were suggested on top of that, which we now see as a consolidated technical analysis procedure in the current markets, right? So if you look at it, he used to use the same higher highs, higher lows, lower highs, lower lows in order to understand what is the kind of a trend that is running in the market, what is a counter trend that is happening. He has defined the trend in different ways, and there are certain things that was considered to be important as far as Dow theory comes into the picture, and some of the trends were actually discounted, that okay, this is not a very major trend that we need to take a look at, right? Based on the published articles, many experts have interpreted the Dow theory in different ways, but ultimately, six basic principles of Dow theory has been widely accepted. So we will look at those principles one by one, and then he came up with Dow averages. We will talk about that also. So there were two Dow averages that he came up with: the DJIA, the industrial average, so which I think was comprised of around 20 companies, and then he had something called a DJTA, which was the transport side, which was actually looking at around 12 or 13 railroad companies that were running at that point of time. And his idea was that if the whole bigger economy, the 20 companies economy, is actually doing good, then the DJTA, the railroad company, should also be doing good. And if they are moving in different directions, then there is some problem in the market, right? So the idea was to understand why the classification was done this way. And by the way, the only company that was there in the first Dow Jones index that was created around that time in the early 1900s, the only company that still exists in that is the General Motors. Okay, General Motors is still there. It was removed from Dow Jones around 1950s and 1960s, I think, for a few years, and then it was included back. Other than that, none of the previous companies that were originally a part of the actual DJIA is existing in the index anymore. The companies may not be there, or they may have fallen off the index, and it is more concerned about the overall market trend compared to the movement of the stock. So the idea was that if all the businesses are doing good, now think about that point of time, right? At that point of time, we did not have electronic products, we did not have product services as products, right? So they were physical products which were manufactured by companies, and then it was distributed to the customers, and the customers were using those products. Now, the way to transfer these products from the factory to wherever a warehouse, and then to the retail stores, and then to the customers. The primary infrastructure to do this was the railroads, right? So that is why the railroads, that is the reason he created the whole index based on the companies that were running the major railroads at that point of time. So the idea was that if the businesses are doing good, they are selling their products to the customers, and their profit margins are rising, their balance sheet is getting inflated, or it is getting better, their cash positions are getting better, they are making better profits. At that point of time, the infrastructure companies should also be making equally good amount of money. The way that they are taking the products from the companies and to the customers, if that stays consistent, then there should not be a change in the direction of the move of the business companies versus these transportation companies. So this was the basic idea based on which this whole Dow theory was created, right? So the Dow theory was not created by Dow. He just wrote those articles. Based on those articles, subsequent traders, analysts, experts, they have come up with the Dow theory based on whatever was mentioned in those papers. So let us look at the six major tenets or the principles that Dow theory talks about. The market discounts everything. What does this mean? And now you will find very close relationship to what we keep on talking every day that do not listen to the news. So and I'll show you a very interesting example of what happened during COVID. So what Dow theory is saying is, whatever information is available in the public domain, it is discounted by the market immediately. There may be a follow through action to that, but the actual effect of that particular information is gone as soon as it hits the market. People have already taken action on that, and some of the people, some of the traders, some of the fund houses, or at that point of time, whatever it was there, they will actually position themselves in a way so that as soon as that market event has happened, they can take advantage of that and ride the trend in whatever direction it is going. So whatever information is coming into the public domain gets discounted by the market. What does discounted mean? The effect of that particular news or the particular information that has come into the market, it gets accommodated in the price as soon as it hits the market. It does not take a lot of time. And if you think about it, that is why we say that, okay, do not look at the news, rather look at how the market is reacting to the news, and based on that reaction you can find better trade. So these things have been existing since the last 125 years, right? Any news information available in the public domain are reflected in a piece of stock and indices. This includes all the data, including earning announcement by companies, rise and fall in inflation, or even sentiment of investors. So we have seen so many times, right, that a market has given a very good guidance. The market has a particular company has given very good guidance. They have a very good EPS. Everything has beaten the market. The company in the aftermarkets, when the actual report was published, it actually went up by 10%, 20%, right? What happens the following day? We see that the whole profit that those people got in the aftermarket based on the news, it actually gets discounted completely, and we get a total red day. And the reverse also happens, right? You have a very bad EPS, you have very bad guidance, but then the company is known to be a very good company. It has the returns and the total EPS to the investors. The guidance of the company has been really, really good over the past 10 years, 20 years, 30 years, or since whenever the company has been there. At that point of time, we will see that the market has taken a little drop, but since the company is so good, the investors are reluctant to give up their stocks. And even after a bad pricing, maybe a couple of days of downtrend, the company will actually start to move back up in prices again. So it is important to look at what is happening to the price compared to based on the news that has come in, compared to what the news actually is, right? So these principles have been there in Dow theory, and people have been practicing this for multiple years. And we will see a very good example that has happened in our recent times. As a result, as per Dow theory, it is prudent to analyze the price movement rather than a single earning report or balance sheets of individual companies. Okay. So this is what we call about the market discounts and everything. Before we get into that, let me talk about the example that we were looking at. I will go back to the regular ES1 chart, or let us look at SPX chart, and we will look at the monthly chart, right? And if you remember, anyone remembers when the lockdown started after COVID? The lockdowns after COVID started on 25th of March 2020. That was the first time the lockdown started in United States, right? This was the area, correct? This is March 2020, right? So this is the month when we actually had the lockdown announced. So the lockdown has been announced. The that news has been discounted in the market. And then immediately people started buying it. See, from April onwards, we started, this happened in March. April onwards, the market started pushing up. Why? Because at this point of time, the investors were looking at the fact, okay, the lockdown has happened, right? Now the businesses can actually, they are still functioning, but in a remote way or in some other way. And as soon as they saw that there were not much effect on the functioning of these companies, maybe the smaller companies, the mom and pop shops, they have shut down, but the bigger companies, they were already into plans of how to deal with this, right? And based on that, the market started moving. The investors actually positioned themselves right here, and then the market started moving. And from 2020, we have come up almost 200 points, 200% to the upside, right? So this is what matters. By the time, so that is when I say that, oh, okay, when your mom starts talking about Bitcoin at the dining table, that, okay, do you have Bitcoin, should I use some money and buy some Bitcoin, that is the time that the market is about to take a turn, right? So we will have to see, look at the market cycles, and the market cycles have been was described in the Dow theory as well. We will take a look as we go forward. Any questions so far? Did you understand what I was trying to talk about with relation to the COVID and then the market discounts, everything? Any questions? Okay, let's move on. So, based on the Dow theory, there are three basic trends in the market. The one of the trends is the primary trend, which is a trend that goes on for years together. Then there is a secondary trend, which we call as a correction or a pullback. This normally stays between somewhere around 3 weeks or more. And then there are these minor fluctuations, which are the intraday fluctuations that are happening to the prices. But these minor fluctuations are not a part of the Dow theory. But as we go through it, you will understand that it is the exact same way that the current price action principles or the current price action rules that are taught in different forms and formats have evolved from these same concepts of Dow theory. Right. So under the primary trend, again, we have the uptrend and we have the downtrend. So these are the only two kinds of trends that we can have. When we are talking about sideways movement, Dow theory actually defines it as a line. Whenever there is a sideways movement, he defines it as a line, and we will understand why he was calling it as a line. So first we have accumulation. In the uptrend, we have accumulation, same concept. Then we have the public participation. Once the accumulation happened and the market started moving up, that is when the public started participating into it. And finally, at this point of time, so think about it, he is looking at it for years together. At this point of time, when you are looking at the public participation, everyone is euphoric, right? They are getting into the market, they are making money, the market is going up in one direction, they are not bothered about the small pullbacks and stuff like that, and the market keeps on moving up, and they are happy that they are making money. Now a time comes, everything cannot go on forever, right? So if, say, for example, Tesla is making money right now. Now a point will come when the market will stabilize, when this particular EV market will become mature. At that point of time, you will need more invention to come out in order to push the market higher. So for example, let us look at the smartphones. when the smartphones started coming into the market, the around 2016, 17, 18, you will see that there were a lot of innovations which were coming into the smartphone market. But right now, if you see, the innovations are just happening with respect to a minor change in the processor, a minor change in the cameras. So that trend of innovation that was happening in the market has now actually saturated. Now they are trying to come up with different things, with folding phones, with folding displays, curved displays, but that is not proving enough to push these companies or this particular market of smartphones into a different level. So maybe the maturity has come for the market. There may be downtrend in that industry for some time. I'm just talking about hypothetical scenarios. The balance sheets are of those companies are not growing as much as they were growing earlier. So maybe that maturity stage has been reached. This excess stage has been reached. And at this point of time, the different companies or the different investors in those companies are actually thinking, is it a good time to sell out of this? Is it a good time to still holding on to this particular instrument or to this particular stock? But they are not giving up as well. Especially what happens when you see that there is a sudden downtrend that has started, you will see that there are certain companies which are falling with the market. If the market has fallen 20%, those companies have fallen 20 to 25% as well. But many times you will see, or most of the times you will see, that the good companies which the investors do not want out of their portfolio, they will keep holding on to those companies will also drop. But maybe if the market has dropped by 20%, that company will drop only by 10% or 15%. And as the market turns back again, those companies will pick up. So these are the different aspects that the investors or the market makers or the big fund houses or everyone is looking at and putting in their money when they are feeling that the market is at its bottom and it is not going to go further anymore. And then based on the price action theory, we actually look at what is happening, and based on that we can actually place our trades. Think about it. The same concept of the uptrend, the downtrend, the accumulation, the distribution, the public participation, the panic. When the panic starts in the public, that is when these fund companies or the big investors, they start coming into the market and they start accumulating their positions in the market at this point of time, because they know that the public is frustrated at this point. They are selling out everything. This is a very cheap price at which they are being able to get those particular instruments, and that is when they start buying into it once again, right? So primary trend is the most important trend in the chart. It can last for a year or more and can provide 20% or more appreciation or depreciation in prices. So for example, if we look at this particular chart and we look at the 12-month chart here, I think I have it here, 12-month chart here. Okay. So if you see the 12-month chart, what do you think is the main trend here? Of course, it's a bullish trend, right? This, if you see from here to here, if I consider these 2 years right now, from this bottom to this top, we had just a 50% retracement, right? And after that 50% retracement, the market just went back up once again. And if you are looking at from the perspective of the rules that we normally define, if you are looking on a year-to-year basis, the market's target is somewhere around 6,132 based on the amount of this particular pullback, right? And now if we are being conservative again, and if we are trying to do a 1:1 of only the body of this pullback, you have already got that. You have already got that 1:1 move to the upside, right? So these are the different things that were there, that was based on the Dow theory or the Dow principles. These are the same things that are being followed by the market for so many years, and we are still continuing to use the same principles. There might have been a little bit of changes, there might have been new things that has been added to the concepts, but the basic principles still remain the same. Okay. So the secondary trends, this was the primary trend. The secondary trend or swings are the corrections that happen in the direction opposite to the primary trend. Secondary trends are also composed of minor trends which happen on the daily level. We call that the daily fluctuations of the market, which are not considered as a part of the Dow theory. So Dow theory only considers the primary trend, and then it considers the secondary trend. Now, there are certain characteristics of the secondary trend that has also been defined by the Dow theory. The primary trend identification happens with the formation of higher highs and higher lows, or lower lows and lower highs, whichever direction the primary trend is. The major or the primary trend is the trend that long-term investors are concerned about, as they are in the market for the long haul, irrespective of the secondary reactions and minor fluctuations in the market. So as long as they do not see that a major low or low is taken out at that point of time, till that point of time, they may keep on holding to their positions. They may keep on accumulating more positions with the expectation that the market will not take out the lower low. But if they see that the market has actually taken out that major lower low, which everyone was looking at that point of time, people start to think that, okay, this may actually turn into a primary trend, right? But then we still keep an eye on how far the market is going to come down before we decide which way the market will go. The secondary trend may bring market down to the one third or half or even two-third in the direction opposite to the primary move. These look familiar. 33%, 50%, 66%. Right? So the pullbacks can come down to the 33%, the secondary trend within the next three, which lasts for around 3 weeks or more. It can come down to the 33%, 50%, or the 66% of the whole thing. Now, if you look at a smaller time frame also, you will find that these actually work out, right? So let us just look at the 5-minute time frame here. And in the 5-minute time frame, when we had this particular swing, the swing started from here, from this bottom, and we came up till this point of time, this price, right? This was the high and low of the swing. Now you will see we came down the 50%. We could not even get to the 66%. We went back up the 50%, and now we are below the 50% again. Now we will have to see if this two-third area is breaking down, if this 79%, 89. See, these are new additions which have come into the market with new studies, with new analysis, with new analysts and experts coming into the market, reading the fib levels. Apart from, what are the other important fib levels apart from the one third, 50%, and 66%? And these levels have evolved over time in order to provide much more structure to the market with respect to what the investors want to see or the traders want to see. The major or the primary trend is the trend that long-term investors are concerned about, as they are in the market for the long haul. We saw that. A secondary trend is confirmed by a counter trend move of at least one third of the primary move and lasts for at least 3 weeks. If this does not happen, if at least one third of the primary move is not taken out, we do not consider that it is a secondary move. We will consider that as a minor fluctuation that is happening in the market. So that is why we still use that 33%, 50%, 66% lines. Along with that, we have come up with several other lines as well within the fib levels in order to decide where the market is heading to once it has broken down a specific level. The minor trends can be seen as minor fluctuations in the market in the counter trend direction and do not last for 3 weeks and mostly for a few days. Now, when we say there will be a couple of legs, it can be sideways or it can go down. That is what he means by a line. When we look at the Dow theory's analysis, he calls it a line. Now, understand, there is one more principle after this, or not a principle, that's actually a disadvantage. Dow always went by just the closing price, nothing else. Over the period of time, the OHLC concept has been evolved. Okay, this is the open, this is the high, this is the low, this is the close. At that point of time, he used to go only with the closing prices, as a result of which the whole trading range concept, he described it as a line, right? He will look at a line where the price is closing continuously at that line, and that line may actually substitute for a secondary move when we are saying that the price is actually moving sideways, and even if it's getting legs, it is getting the legs in the sideways direction. Move of price above or below this line is followed by additional extensive move. Now think about this. This is the trading range breakout. So once we have broken out of a trading range, and if that breakout is successful, at that point of time, we will say that, okay, this is going to break out and it will get an extensive move beyond this particular trading range. And then we have the several measured move concepts, how far the market can go, how far the market can drop. These are the different things that we look at. Okay, tides, waves, and ripples. Think about it. If you're saying that a tide is the highest point, when a tide comes, that is the highest point, and when the tide goes away, the farthest it has gone from that highest point is actually the lowest point of the tide. Right now, when the tide, when the high tide has come, say this was the highest point of that high tide. After that, it starts receding. Now it just does not recede totally together, right? So if the tide is, say for example, a mile long, you are not expecting that as soon as it has hit the 1 mile mark, it will just go back 1 mile immediately. In between, it will try to come up, but will not reach the high point at that point of time. It will again go back a little bit and then come back up again, but this high will again be lower than the previous high. Right, so this is how we are seeing that, okay, this high was there, now the tide is receding, we are not able to reach that high anymore, but the recession of the tide, or the receding of the tide, is not happening altogether. There are waves coming in now, and inside the waves there will be smaller trends which we will call as ripples. So we consider the tides as the major trend, the waves as the secondary trend, and the ripples as the minor trend. So this is the way it was actually described in Dow's original papers. And then the analysts and the experts, whoever was reading that, they found very good similarity, or they found these examples to be really helpful when trying to identify the market. And then with relation to the tides and the waves and the ripples, now think about how we compare that to the higher highs, the higher lows, the lower highs, and the lower lows in the market. Making sense? Any questions so far?
Sabaj, one quick question. If you look at the
Hmm.
waves, I mean, after the most recent breakout from the previous big pullback, so when do we consider it as a starting of a new leg?
Okay, we will talk about that. There are
Okay.
there are certain calculations. I think I have it here, or no? No, I don't have the calculation. So what it normally says is that the market needs to drop at least by 20% from its first major low to the first major high. So between that swing, if the market has fallen below 20% of a swing, at that point of time, we will say that there is a possibility that the market can come down lower, right? And how do we define that 20%? In the current fibs, that is the 79% line that we look at. So Dow said that it was 20%, right? But we are considering, we are being a little bit conservative. We are putting the line at 79% and trying to see if it's coming down further. If it's breaking down the 79%, most of the time we see that the price comes down to the 66% or to the 50%. And from there, that is why the 50% line becomes so important, because many times you will find that the price starts holding at the 50% line, especially in a bullish market. Or if the market actually turns bearish, then you will see that, okay, the price may actually be doing the same thing, because now the bearish market has become the primary trend.
Okay.
Right. So once the bearish market becomes a primary trend, at that point of time, you will say that, okay, the market may be turning. But then look at this. We say that the primary trend runs for at least 1 year or more, right? So we had this primary trend running for 2 years here, for 3 years here, right? And then we had a pullback here, and then the price went back up again. Now, if you see, this is the whole life. This is the whole life of SPX.
Yes.
correct?
Mm.
And if you consider the whole life of SPX at this point of time, if you see this was a double top here, this double top went up, and now if you count the number of legs from this particular low, just for an example, this is the first leg up, this
Mm.
is the second leg up, this was the second end of the second leg, we came down, this was the third leg up, we came down again, we are in the fourth leg up in this lifetime, in
Yes.
this whole lifetime of this particular chart, starting from here, not considering the previous one, from here, from this new low that was created, this is the fourth leg up. So you never know if the market actually enters into a very bad recession at some point of time. God forbid that does not happen. We can actually come back to these levels once again, right? For a 2 to 3 legged pull back to the downside, and then we will see whether now those moves have to be huge moves, right? We are not expecting those moves to happen. Even if we consider that this is the low, and from here we had the 2 legs up, just to come down to the 50% area, the market has to drop almost 2,000 points at this
Yeah.
point of time,
Mm.
right? So even if the market drops, how much will it drop?
Yeah.
It is not that from 6,000 we are coming down to 1,000 again
No.
in the next 1 year. No, that is not going to happen. So
20%
the
fall.
markets are always in a bullish
Bullish.
move,
Yeah.
and within the bullish moves there are certain pockets which creates this pullbacks or corrections, where some investors become wary of the fact that maybe the market has become matured, maybe the market has moved up too high and I need to take some profits, and in the process the bears think that the market is going down, they start selling into it, and they
Yes.
start selling into it.
Yes.
So then you will see that there may be, remember during the Japanese interest rate scenario, how many weeks did the market drop? Think about it.
Yes.
Exactly 3 weeks. Let's get back there. This was the Japanese drop,
Mm. Okay.
right? This was when, or this one actually, April. It happened in April or here? No, I think July. This is the drop. Again, see the market dropped just 3 weeks. Right here, it dropped a little bit more. 3 weeks, we did a pullback, and we came back here. The market was so bullish here. See, these did not get a second leg. Also, the second leg actually came above the high. The second leg actually came above the high. It went to the high, and then it got the second leg. Right. So
Yeah.
these are the areas which now Dow may be calling as lines, right? Because this is what the trading range is about.
Yes.
And if you see, if we are trying to see if what we did to the trading range, if this was a complete trading range, the high of the trading, the 1:1 of the trading range is somewhere about
6.
5946. So the 46 to the 50 area. So there is a big possibility that we can come and hit that as hit that level again.
Mm.
So on the weekly chart, after this low, we had the first leg up, we had the second leg up, and now we have the third leg up. Now we will see if this forms a final flag, goes up to the 6,000 area, and then starts dumping. So that may become the final flag at that point of time, and we will get that fourth leg to the upside, and the market will stall there and come back down.
Oh, okay.
So this is how the market moves. But when it comes back down, it is not that it's going down forever.
Mm-hmm.
Right? It will pause somewhere, and then the market will see whether this is a good value to buy again. Right? Because in 2 years we have come from 2,000 to 6,000. So it is not that we are not in such a market, we are not in such a global economic scenario. Even the US scenario is not that weak that the market will fall from 6,000 to 2,000 in the next 6 months.
Yeah.
So those are the stalling areas that we need to look out for. And in the similar way, we actually connect these things. If you think about it, the process we trade nowadays is very similar to what I'm talking about, and these were written in those analysis papers back in the 1900s.
That is true. Yeah.
So basically, Subhajit, it
Yeah.
is just explaining the trend, how overall the market behaves.
Correct. He actually developed this whole indices not for trading or not for forecasting. It was just to validate that what is the current economic condition that we are in.
Mm.
Okay, so he created these two averages, the DJIA and the DJTA, and based on the confluence of these things, he used to say that whether the market can go up further or the market can go down further. So if one is making a higher high and the other one is making a lower high, at that point of time it becomes confusing. So now you will be looking at the broader market picture. So if you are looking at the broader market picture, DJIA, it is growing. So what his interpretation was, if DJIA is growing, even if the DJTA is falling back right now, it will actually catch up with the DJIA. So based on that, now these two indices, in whatever form they were there, they are no more there in that specific form, right? Many companies have gone in, many companies have come out. As I said, only General Motors continues to stay in the original Dow Jones Industrial Average. Right now, based on this thing, many people are now looking at correlations. And based on correlations, many people have come up with combined indices that is absolutely personalized. Many people have sell these combined indices as a paid service. They have combined DJIA, they have combined ES Mini, and they have combined the Nasdaq in order to create a composite index to get a better idea of which way the market is moving. Right. So what they are saying is, if a group of companies, the majority of the group of companies is moving in one direction, the rest of it, although it is not moving right now, they will keep moving in the same direction as well. And some at some point of time, the trends in all the three indices will catch up. So that is the way people look at it, and that is why there are so many different indices that are there in the market, which are called composite indices, and they are actually made out of a combination of all these three. So when I was working for a short time in S&P, I found that there were multiple indices that were being developed at all times, right? There were different kinds of indices that were being developed. Some were done by the internal research team, and some used to be done for external clients who used to come and ask for the creation of certain indices for the market. Right. So in any index company, it is not that they are sitting on a single product, right? They are continuously working for their clients. They are creating new indices based on the client requirement, based on the new trends that they are seeing in the market, and based on these particular things, the different indices evolve. People start using them, and those indices may become popular at some point of time once again. Volume dictates the trend. Trend must be supported by volume. So whenever we see that the market is expanding, the market was in a contracting phase, and then the market starts expanding in whichever direction it is expanding, we see that there is a sudden spike in volume. Now, according to Dow, this volume analysis can be done after a cluster of days. Okay, the volume analysis, if you're trying to do on a daily basis, that may not actually give you enough information in order to gauge the direction of the market. Right. So when you have looked at the cluster of volume over a period of time, that is when it will tell you that, okay, the trend is being supported by the volume that is there. That is why it becomes farther. So he is saying that looking at it on a daily basis becomes difficult. So think about it, if we start looking at the volume on each bar on the 5-minute chart, how confusing that can be. So that is not something that we look at, but then we say, right, that okay, there are 5 bars which went up and the volume has been decreasing, so the market is not supporting that. We do say such kind of things, but those, think about it from the Dow theory perspective, we are just talking about the minor trends which he does not even consider. So we are using the same concepts, putting it in the smallest time frame possible and trying to make sense out of it. So that is why most of the price action rules and most of the people who teach price action, they actually say there is no need to look at volume. But then there are proponents in the market who actually look at the 5-minute volume and make sense out of it. Right. And now there are different ways to look at volume. You can look at the regular volume bars that are coming below the chart. You can look at the market profile. You can look at the volume profile. There are several tools in which the volume is represented. You can look at net delta. Net delta means on a specific time frame how many buyers were there versus how many sellers were there. Right now, on a larger time frame, you have seen that there is a specific area of resistance, and the market may actually be moving down, but we still go and scalp on the long side. and vice versa as well, without looking at the volume. So paying much more attention to the price rather than the amount of volume which is moving the price is maybe much more important, because that is where we will find the imbalances in the market. And when we find imbalances in the market, we try to use those imbalances and make money out of the market when those imbalances are moving in the direction where the direction in which we were actually expecting it to move. Okay, trading activity tends to expand when price is moving in the direction of the primary trend. Now, trend continues till there is a definitive reversal. Now, this is where the confusion comes into the picture. How do you define that definitive reversal? Secondary trend should not be confused with the reversal of the primary trend, as long as, which is the last principle, no, as the trend continues, this is the last principle. The trend continues till there is a definitive reversal, and the definitive reversal happens when we have actually taken a close below that lowest line, the lowest close that the market had. If we are closing below that, then we are saying that, okay, maybe the market is turning at this point of time. But then as soon as we are coming out of that swing low, there is another swing low which will provide support to you. So now the market will pay attention to that as well. Now, since this swing low has been broken, we were drawing the fibs from this swing low to this swing high. Now this swing low has been broken. Now we will try to map our fibs with the lower swing low, with the lower swing high, and then see, okay, where is now the 50%? Is it coming down to the 50%? Is it taking support at the 50%? Right? So if you remember, this is the same concept that we have been using for so far. Let me see if I can find that chart out. That it's the same thing that happens every day on a regular basis. I had some trading ranges marked on the chart. I forgot where exactly is that. I was looking at it today morning as well. Is it on ES now? No, it is not here. It is on ES1R. No, it is not here as well. Okay, let us just, I'll just remove everything and we will redraw it. So what we saw earlier was, if I am one of the boxes, what we saw earlier was, we said that this area was creating some kind of a trading range, and then after that we control C. After that we had another trading range right below that. Right now, let's see if I drew it correctly, because otherwise my fibs will not match. Yeah, I did not do it correctly. This had to be the 59. This was the 50%. So again, I will bring that particular one out and I'll share it with you guys on Discord, and then you will see this move up here was actually the exact 50% line of the upper TR, and then we have broken it down, we have come below, and we are almost at the 1:1 extension of the lower TR, or the 50% extension of the full TR to the downside. So those are the things that we look out for, and going by the Dow theory, those are the same principles that we keep on using till this day. Right? How the Dow theory helps technical analysis? It actually explains the trend analysis. At any time frame, if you're trying to bring the same Dow theory concepts to any time frame, you will do the trend analysis in a similar way that was being done for the trend analysis as the primary trend in the actual papers that were published by Charles Dow. Confirmation principle, this is defined by the correlations by indices. So if all the indices together are saying, yes, we are going down, we are into the fourth week of movement to the downside, at that point of time, we say that, okay, the market may actually be going down further, because all the indices are actually agreeing to this particular move. There is no, there is a correlation existing between all these indices. So if this guy is coming down, this guy is coming down, the third person also needs to come down to the same level. Okay, disadvantages. What are the different disadvantages that people talk about in Dow theory? Yes, there are some. Short-term downtrends or secondary moves are difficult to trade as confirmation comes in late. So as long as we are not getting a 20% drop, we are not saying that the price is actually going to go down. Right? Even though there has been, based on the current price action rules, you can actually get onto that trend much before the 20% drop has happened. Only closing prices are used, so we know that only the closing prices are not enough when we are looking at the modern technical analysis procedures, rules, and everything that we have. So now we have the OHLC concept. We look at the open, the high, the low, and the close of the previous day, of the previous week, of the previous month. And it is just not the close of that particular time period, right? We are looking at the open, high, low, close of these higher time frames and trying to make sense of that in the lower time frame, looking at the price action of what is happening on the 5-minute chart. Traders confuse the secondary trend as a reversal to the primary trend. The secondary trend is not a reversal to the primary trend. The secondary trend, as we talked about, can last for around 3 or 4 weeks, and then the market can again turn back up and keep going in your direction. If you have seen 3 weeks were strong, and the fourth week is actually a strong reversal again. If 3 weeks were strong bearish reversals, but mostly they were moving sideways. When we are talking about moving sideways, one bar is covering at least 50% of the previous bar. That is the overlap that we have, right? And then you see that there is a sudden breakout from that area in the fourth week. It creates a new low and then goes back up and closes the market bullish. That may say that, okay, maybe the end of this secondary trend has already happened here. Leaves investors in doubt. Long-term investors become in doubt that whether they should be holding on to that particular trade or they should be coming out of all their positions, wait for a better price, and enter as a value trader again into the market. The indices Dow used to have, with whatever he started with, DJI and DJTA, they have been overhauled over the last 125 years. But I do not think this is a very big disadvantage, because although the markets have evolved, although different companies have come into the picture, although the companies which were there at that point of time does not exist anymore, but the basic principle of the Dow theory, the basic working of the market, the accumulation process, the public participation process, and then the excess process or the panic phase. So these are the different phases which are already defined by these theories of Dow, and we still continue to use the same theories over and over again on a regular basis, on multiple time frames, on different things, on different instruments, different markets, right? And the same concept applies everywhere. And there are still people who are trading by they vouch by the Dow theory, and they do not want to get into the secondary trend, and they believe in the primary trend's continuation, as long as they do not see that there is a 20 or 30% drop from the previous high that has happened or from the previous low that has happened. Make sense? So that is all I had for today. Any questions? Now, Dow theory is something which you cannot understand at one go. I cannot explain in one sitting, right? It's a huge thing. Okay, whatever I said, whatever we talked about right now, it just maybe 20% of the, not even 20%, 2% of the total explanation that we have, right? There are thousands of books which have been written on Dow theory. I have been able to read only 2 or 3 of them. And so there's a lot to learn in Dow theory, a lot to understand. But if you have actually read and understood the Dow theory to its entirety, you will have a very good grasp on the market, and then you will be able to implement Dow theory along with the modern technical analysis techniques, which you will understand is now based on the same Dow concept, into the chart and try to find out what is going on. Any questions?
So, Sabaj, can you do it one more time in the chart? Like you said, like 20% or 19% move, that it's a little bit for the leg counting. That seems.
So, okay, leg counting was not a part of Dow, right?
No,
He
it's
went
like
by
leg
level.
start. Siju's question, the same Siju's question. Yeah,
What
Siju
was it?
asked the question,
Remind
right?
me again.
Siju, yeah, Siju asked the question like where, like if it is one leg is done, and then like you said, it will go 79, I think 79 or 79%.
Yeah, so these are the levels that we use from a mother bar perspective, right? But then you can see that the same level, just look at this, 0%, the 66%, the 50%, and the 33%, right? So this was the swing high, and this is the current swing low. Now we are trying to see how far the market is coming back down, right? So when we came back down, see, the market went up to the, where did it go up? It went up to the 50% area of this particular drop, right? Of this particular swing. We went back to the 50% area. Now, let us forget about this particular one. Let us forget about this particular fib. Now we have a spike to the upside. Now you see till where the market came down. If you're talking, this is the low and this is the high. Again, see, the market got caught at the 50% area. Right now, we are using this on the lower time frame again. See, this is just the 1 hour chart. Now let us say this is the new high, new low, and this is the new high. Right, the market this time came below the 50% area, it came below the 33% area, but we have not yet broken the lower 20%. But this break, of this strong break here of this particular move, was already saying that there is a possibility that the market will come down to the 50% or to these areas once again. So whenever you see that there is the market turning once again, you put on your fibs and try to see, okay, is it breaking the 33% of the latest swing up and low? Okay, is it breaking the so once this swing has broken, once we have come out of this swing, at that point of time we will bring it back here again and try and see what is happening, while keeping in mind the bigger picture here, that okay, this was the actual 50%, the 58.64 line. So that is how you look at every swing. You look at every swing, because we are on a lower time frame. We are not going, we are day traders. We are not going to hold on to our trades for 3 months, 4 months, 5 months. We are day traders who are trying to take advantage of the local swings that are happening, the minor swings that are happening. And based on that, if you put your swing top and swing bottom, if you see that it's breaking down the 50% area, it mostly comes down to 33%. If it breaks down to 33%, we can look for the 21%, 11%. See, it went to the 0% and see where it came and sat. And now this is evident enough that calculations are involved. Why? Because how could it become the 11% line? We know that the 11% line is really good. Now this became the 11% line based on this high. So there is some kind of calculation involved. It cannot be that the 11% became support and the 79% became resistance, and it happens all the time, and it cannot just be coincidence. Right? When a same thing happens multiple times over and over again, it is not coincidence. There is mathematics involved in this. There is counting involved in this, and these are the countings that different machines, different algorithms are doing, and all these things were laid out 125 years back. That's crazy to think about.
Yeah, thanks.
Right? Any more questions? Okay, I will stop the recording here, and that